Hello, everyone, and welcome to another episode of Foresee Markets. I am your host, Alejandro, and I have my co-host with me, Serhii.
Hello, everybody. Today we will be talking about our portfolio and which companies we have there and why exactly our algorithm have selected these companies. So,
That's
Alejandro,
right.
can you tell which companies are there today?
Yeah, so when we're building our portfolios, we are building the portfolios based on how an algorithm has reviewed the overall performance of the company, right? Like fundamentals are extremely important. If you don't have good capital and good revenues on a company, and if the company is not performing well, it's not going to last and eventually it might go bankrupt and you'll end up, holding a bag with nothing in it. So in order to avoid that, when we're choosing a portfolio, we try to select the stocks that are performing the best per their individual sector. And so the algorithm that we use has selected 10 companies, and we're going to be choosing 4 of them for discussion today. So I'm going to share my screen, and we're going to start discussing these 4 companies out of the 10 that we have chosen, right? So the companies that have been selected are selected because they are showing that they have the best fundamental support. That means that their cash is healthy. That means that they are having good sales and good contracts. That means that the way that the company is operating is backed up by their financial earnings and the reports that they have submitted to the Federal Exchange Commission. So for anyone who's out there listening and doesn't know, whenever a company completes their quarterly cycle, they have to submit a report to the FEC, and then this is how the earnings report gets put together. So the first company that we're going to be looking at here is Amazon, right? And if you ever made an order online and you got a package from Amazon, then this is the company that delivered it to you.
Yeah, I think
But
everyone knows Amazon, right?
you would, I
But
mean, you
so
would
why
think,
so
man, but
special about this period that Algo
yeah.
have decided to enter this time? What was the cause?
So the way that the algorithm picked the company is it looks at everything that is submitted on their balance sheet and on their earnings statement and their financial reports. So Amazon has 5 sectors. They have online retail, right? This is basically what you buy through your app. They also do a third-party marketplace. So a lot of times, other people that want to sell things, they don't necessarily sell to you directly. They go through Amazon, and then Amazon handles all of the logistics in relation to the sale of the product. Amazon takes a cut, and then the producer takes the rest. They have Amazon Web Services, or AWS, which is where a lot of these servers and other websites get hosted. So whenever somebody says like AWS, it actually means like Amazon Web Services. So this is something that Amazon produces as well. They do advertising and then do subscription and media. So Amazon Prime, right? Anyone who's watching any of the movies from the Amazon Prime account. And then you get all of this with one single subscription. So they have a very strong consumer base. So that translates into very strong sales. So when we're looking at the price here for Amazon, right now Amazon is trading for 245, and the support that we see happened recently on June 26th, it went all the way down to $227, right? But we haven't really seen that price or again during this quarter earnings. So during this quarter, that is the support, 226. Now, is it going to hit that price again? It's possible. So, but at least for now, for me, this is my support price. So once it hits 226, that's when I'm going to start looking at entering the price or entering the company. If we look at what happened previously over the last 1 year, the company has been having like this sinusoidal effect until finally, about right here, it gave an earnings report that just surprised everyone by about 4 billion. And, that's saying a lot because for a company to have a revenue of 4 billion over what everyone else was expecting, that means that they have to be doing phenomenally well, right? And so that's what Amazon demonstrated. On the previous quarter, they had a negative zero point 0.2 surprise on their earnings. And then on this one, they just blew it out of the water, right? They were like, you know what? We didn't do as well previous quarter. we're gonna step up our game, and we're going to just make sure that we don't let this happen again. And that's what we end up seeing with Amazon. So their resistance price is 276. That basically means this is the price that they have not been able to beat. But I think like a more realistic resistance would go back to the previous quarter, which was about 247. Because if you notice, if you see like throughout the time here, the stock was teetering around this price, like 237, then all the way up to 250 and then down. So when we calculate, when we go in and we actually run the calculations, we end up finding like what is the resistance and what is the support. These are important because when you're going to be entering your portfolio, you can't really time when to enter, but you can select a limit that you're comfortable with, that you're going to try to profit from. So right now we're seeing that the stock is trading at about 245. The max that is traded at is 273, so it could go back up to that price. I personally think that the stock is going to go back down to the price before their last earnings, which is going to be about right here, 224, 225. I'm thinking once it gets to about 227, that's a good time to enter the stock. You got any comments about this one, Serhii?
Yeah, it's pretty interesting to see like how you analyze this chart and what's going on for the company with almost 800 billions of revenue and 79, I think, billions of profits they had, right? So it's like pretty huge company.
Yeah, it's a huge company, and you know what's important is that when you're looking at these numbers, you have to be able to compare apples to apples, right? So, you know, if we're looking at Amazon and we're looking at other companies that would fall within the same sector, if you're comparing a $4 trillion company and you're comparing it to, for example, like Booking.com, which is another company in the same sector, you would be able to see like the different revenues. And then for a period of time, maybe Booking will do better as far as the returns that you are able to get. But if you're looking for like a quality company with a lot of longevity and a diversified portfolio, then Amazon would be something you want to invest in, right? If you're looking for something that is, you know, more cyclical, like when are bookings going to happen? If you look at Booking.com Holdings, so this is the other company that is in the same sector. If we look at this one and their market capitalization and everything else that goes with it, and you compare apples to apples, you'll notice that this is a much, much smaller company, but it's trading for $181, right? So you can pick up the shares at a lower price, but that doesn't necessarily mean you're going to be making more revenue, especially because if we look here, the lowest price they've had was 153 over the last 52 weeks. And then they had their dividends date, so 0.42 per dividend. And now we're waiting for the earning call to come on on August 5th. So we're going to see a lot of volatility come to this day. But for me personally, although Booking.com is also a strong company, if I was going to put money on it, I go with Amazon simply because if the two are competing for my money, like where am I going to invest? I would go to Amazon because I like their fundamentals and I like their technicals a lot better. Like I always find that Amazon has more support and you can profit on it with shorts and puts, like short puts and short calls after you buy the stock. So there's a lot of ways to profit from this particular company, especially because of the volatility and it has the fundamentals to support. So this is why I like this company.
I love how you put it, like the companies out there in the universe are competing for your money. So
Yeah, man, that's what
basically,
they're
that's what
doing,
they're doing,
right?
right? Yeah.
Like, where am I gonna put my money? Who am I gonna give it to? That's basically what it goes down to. So the next company that we have is Eli Lilly. So this is an interesting company. They are a medical company, and they you know, I have notes here, so I'm like looking on this screen because they develop and they sell prescription medicines. They have diabetes and obesity drugs, and they do research in the drug pipeline, right? But a lot of the revenue is concentrated in like 5 drugs. And I think Serhii was reading up on those. So I don't know, Serhii, you want to tell us a little bit about them before we get into the technicals?
Yeah. So basically, like, actually, it's new company for me. I haven't heard about it like much before, but like, this like $1 trillion company appeared,
Yep.
and one of the top drugs that they do, it's like 9% of their revenue is breast cancer, and another 7% it's like treatment for type 2 diabetes, and it's like another 6% of autoimmune diseases. So basically, yes, you are completely right. So like five top medicines that they produce is basically almost 30% of their income. And it's like pretty interesting. It's a huge one. And almost
Right.
everything, all operations and all income come from US, like majority of it. And
And
very
and
small
that's what's in
percentage from
yeah, and that's what
Europe. It's like 20%, I believe, from Europe comes. So yeah.
and I think that like really explains the 80-20 rule. Like for anyone who's not familiar, like 20% of one item covers 80% of something else, while 80% of something only covers 20% of one particular item.
Correct, right? 80 to
Yeah, and
20.
and in this case, Eli Lilly is right out there showing us why that's true. So now, if we look at their technicals, you'll notice that they had a huge growth starting in October 20th, all the way until yeah, like from October 30th all the way to November 20th, like the company just like skyrocketed in price, right? Then they were pretty stable and falling up until 29th of April, and then again here, boom, they skyrocketed. So why? Well, it has a lot to do with their earnings, which is the things that we track, right? They had a surprise of 1.5 on their earnings. So it's a 22.64% surprise on the positive. And also on revenues, they had a 1.98 billion surprise, which is 11%. So the market repriced the company based on that when this earnings came out. So their next earnings call is going to come in August. So it's going to be on August 5th. And right now their support price is, very low. It's like 853, and this is right before their previous earnings call. I think their new support is somewhere around here, 1096, but don't quote me on that because we haven't run a full system of analytics. What I'm going to do with this particular company is I'm going to continue to watch the volatility and compare with other companies within a sector, which in this case, for Lilly, let me see what pharmaceuticals. So I'm gonna compare how it does against other companies in this industry, as well as the main sector, which is health, and see how well this is performing within those bounds, and then from there determine what is going to be my support price to enter. The reason why that's important is because if you enter at a price that is much higher than the support, you're going to limit your profits. So you want to be able to find that support and you want to make that your entry price. If you manage to do that, then you're going to stay profitable. If you enter at the resistance, you're going to enter at the peak and you're going to go down. So you don't want to enter at the resistance. Like do not buy companies at their 52-week high. That's just something you don't want to do. And right now,
Other capital is
Eli
trying to
Lilly,
exit at this point, right?
yeah, so like that's what we see here. Like somebody tried to sell a little bit higher, nobody bought it. So it's just like holding at this price here. And I wouldn't be surprised if tomorrow when we wake up, we see that there is a bit of a sell before the company just like stabilizes. If you look at the price over the last 52 weeks, right now the company is selling at the 52-week high. So this is not a good time to enter the company. If I was gonna enter, I would probably wait until it drops to probably about here, like anywhere from 900 to 1,000. Then that would be my entry price. Why? Because the previous resistance was right here at about 1,100, like I never made it past that. Now the new resistance is here about 1,200. So if we look at how much it dropped after the week's high, it went from 1106 all the way down to 981, right? So that's almost what, like a 10% drop, 30, right? It's about 10%. So if we follow the same pattern right here, this is about 120 on the drop. That means that it would have to drop from 1242 by 120. So that is 1120. But I think because we're so close to earnings, it's less than a month away. we are probably going to see it drop more before it goes up. And then we have to see how well they perform in earnings. So I'm definitely going to try to get in before earnings, but I'm not going to do it right now. I'm going to do it once the price gets closer to the support. Next company that we're looking at is GE, and this is GE Aerospace. So GE, they build commercial aircrafts, they have engine services, and they do defense and propulsion technology. So if we're looking at the company and why it's performed well, on the previous earnings call, they had two surprises, but they didn't really do much to the price of the company, right? Like the price still deteriorated. But then the company started to go up in price and we're right before the earnings call. So they gave dividends, and the surprise for this was, pretty large, almost $1 billion, so almost 10%. And then the earnings was 16%, but then the price still depleted. So I think that people were just trying to grab their profits, the investors. They made enough profits that were trying to grab it. They didn't really think the company had a lot of strength. And so they decided to sell off. Then other people came in and they bought the dip. So that's basically what this is describing. When we see here, all of these people coming in and buying when the dip happens, they're looking at the company and saying, this is a profitable company. There's no new development except the next earnings call. So we're going to go ahead and start investing on it. So the company went from 282 all the way to 366, almost $100 in the span of about two months. It grew by like 30%. So huge intake. What I'm going to do with this particular company is once it goes past the earnings and I see if it follows the same pattern, that's when I'm actually going to enter. So the current support for me is about 318. I think that after the earnings happens, it's probably going to drop to, something similar to what happened before. So from 318, it went all the way down to 270 or so before it started to go back up again. So that means that it dropped by about $60, right? I'm thinking this is going to keep on dropping until earnings. When earnings happens, it will also have a drop. And then that's when it's going to be my time to enter. Questions, comments?
It's interesting. It's like General Electric's aerospace division, and
Yep.
so interesting dynamics, almost linear growth from April 20th, I think 2023,
Yeah.
right?
Yeah.
Yes.
But if you look at like the whole year, if we were actually looking at the entire year of performance here, you see it was like steadily growing, then it drops, then steadily growing, and then it drops, and it's a pattern with this company. Like right after they had their earnings, drop. Why? I have no idea, but it happens like so repeatedly. So that's why like when you start to notice these patterns, it's not like you have to do real analytics on this. You can
Oh
just
my
know
goodness,
that
look
like,
who's this. Really?
yeah, it's every time. Look at
Every
that.
area needs a
Earnings
drop.
drop. Earnings drop. Earnings drop.
Just shocked
Right?
it when her
Earnings drop.
today and that's it.
Yeah. So what do we have to do? We have to wait until the earnings happens. Right after the earnings, people are gonna sell off. That's what they've been doing all the time at this company. Once the sell-off happens, buy the dip, and then you could be, on this upswing here, so where you can be collecting your earnings. And then the last one is Micron Technology. So we have done one episode on Micron and STX, which I think is Seagate, if I'm not mistaken. These two companies, they create the hardware that you need for AI to work. So now there's so much speculation about AI and what it can do for us and how much it works, and how it works, that everyone is going in and basically buying anything that is AI related, especially hardware. So for anyone who's been paying attention to Micron, they seem to have these events that happen where they have a very spectacular growth super fast and then a dip that follows right after, spectacular growth to like 1187 and then dip like a crash, and then spectacular growth again and dip, spectacular growth and dip.
It's like very
So
interesting company, I would say, because basically they have like 37.4 billion of revenue, and like
yeah,
operating income, it's like around 10 billion as far as I remember. But on May 26th, of this year, basically Micron became the latest US company to reach like US 1 trillion market capitalization. So like taking into account their like profits, it's like 100 years to cover the capitalization of $1 trillion. It's like
Oh yeah. And that's what's really, yeah, that's what's interesting because basically, when you're looking at the trailing 12 months of earnings for the company and what the market is saying that the company is worth, it's the market is buying the hype of the AI. Is that a bad thing? No, actually not at all. If you can read the signs, if you can read the tea leaves, if you will, and you're looking at this company and you're looking at what's been happening continuously, if there's enough volume to support the price, then get in and get your profits, but don't get in when the company is super high. Recently, the company dropped as low as 860 before it skyrocketed again, and now it's down to 920. Is it gonna continue to drop? Possibly. I wouldn't necessarily buy. For me, an entry price for this company is closer to like 700. That's where I would enter if I was gonna enter this company. And I would probably buy something like maybe 200 shares, right? Maybe put it like somewhere around 75,000 to $150,000 to put on this, and then exit once it crosses the $1,000 bounds. Because even if it continues to go higher to like 11 or 1200, given all of these drops, I wouldn't really want to wipe out my earnings. So what I would do is enter when it gets to about the 700 price range, hold it until it reaches, 1,000 or more. Then I would put in a trail stop at about 4% so that I can continue to get my earnings. And as soon as it hits 4% from the peak, my order becomes a market order and then it just gets sold. And 200 shares with the massive amount of volume that this company has, it's not going to be hard. Like look at this here. On July 7, during a 1 hour of selling, they sold 1.8 million shares, you know? So that's just
it's
pretty
pretty
incredible.
volatile. Pretty
Yeah,
volatile.
yeah, exactly. They hear another 500 on the same day and then like before it went. So that means that in one day, I think the company might have sold something like 2 million shares. So just think about that. If you happen to have like, say, $926 million and it's just sitting there, and you're like, I want to buy a million shares of this, it'll cost you 926 million. But because of the volatility, you could either enter here in the low at 1082 and then exit here $100 later, and you just made $100 million, right? Because you went through, you bought 1,000 shares, right?
Still, it's not. It's nuts. It's crazy. Imagine this company has 53,000 of employees, and it's like this kind of volatility, right?
Right. And this is what I'm getting at, right? Because when you see here, look, 2.7 million shares right here at the dip. So you're like, okay, I'm going to buy a million shares. And then you hold it for a couple of hours. It goes from 1090 all the way to 1167, right? About right here. So it's almost $100. If this was one person buying 1 million shares and it made $100, 100 times 1 million is 100 million, right? This is just like straight numbers. So if this was one person, which obviously it
If you
wasn't,
miss
they
that
just made.
selling point, it might go down as well. Sorry, you
Yeah,
can
if you had
lose
an
that
exit
lots of
here,
amount.
if you had an exit here, then you would have lost like $200 million. So that's why this is so volatile. But it's this when you have this kind of volume, the reason why I bring this up is because when you have this kind of volume, you have to understand that you don't have to make a lot of profit. You can make profit on the volatility of the stock. So if the stock is selling 100,000 shares in 5 or 10 minutes, and you have, let's say that you have $80,000 or $100,000, and you buy 200 shares of this, and then it goes up by $10 that quickly, then your 200 within that very small time span when it went up by $20 becomes 200 times 20. I actually don't know what that is. Sorry, what's 200 times 20?
Let's just do concession because
200 times 20. Yeah, so you just made like $4,000 in a matter of seconds. And then if you divide it by the money you spend, so it'd be 200 times 865. So 865 times 200. So it's 173. So 4,000 divided by 173 times 100. No, wait. 4,000. Yep. Divided by 175,000 times 100. So you just made 2.3% return in a matter of seconds, you know? So that's the point, that when you
If
have a
you're
stock,
in the right direction. But if you're in the
if you're in
wrong
the right
direction,
direction, if you're in the wrong direction, you could lose a ton of money as well. That's why you want to enter at the dip, right? Enter when the company is at the lowest point that you are able to um stomach, you know? Because if you enter here at 900 and it drops to 600 before it actually goes back up, you just lost a ton of money, right? So always wait until the company drops to the lowest price that you're able to stomach. And then from there, don't rush. Like if you see the company dropping a little bit more, don't sell off. You just bought the dip, wait until it goes up again. Especially when you have a company that has historically been going up in price. As we see here over time, especially starting here in March, the company has had an incredible growth and it keeps on getting repriced. Like every time I look at the news from the company, Goldman Sachs and Micron Technology is one of two stocks expected to drive about 40% of the S&P 500 earnings growth, right? So that's discounted from Goldman Sachs, and they're saying that like 40% of the S&P 500 earnings growth is going to come from this single company. So that means that if you buy this company and Goldman Sachs is right, you are buying 40% of the growth of the full S&P 500. Pretty interesting. Okay. And yeah, that's actually everything that I had for today.
yeah, very interesting journey across different companies. There's history, there are sizes, because like when you're investing in this stocks, sometimes you don't even know like what you're investing in, and it's really interesting to deep dive into separate companies, their history, like how many employees they have, like what they sell, like basically are like learning the economy. How
Oh yeah. And you know what was like the most interesting thing about this is that when you are buying the stock of this company, you're basically saying, I am willing to bet that my money is going to be better saved as a stock than saved in the bank, right? So you're not saving your money as cash, like US dollars or, Emirate dirhams or whatever currency you may be getting from whatever country you may be in. You're saying, I'm going to save this as a company stock, right? So that means that every share that you have is worth a certain amount of money, and then you are going to hold it until you decide to cash out. At that point, the stock may be going up or down in price the same way that the dollar will erode, right? Because of inflation. So what this tells us is that the company that you're buying has to beat inflation when it's being saved. And the only way to beat inflation when you make an investment is if you buy when the company is at the lowest for that earning cycle, right? Because every earning cycle, you're going to have different prices. But if you're buying at the lowest for that earning cycle, it's very likely that unless it just continue to erode, by the time the earning cycle actually happens and you sell at the resistance, then you're going to buy low and sell high, which makes you a profit, you know? At least that's how I do it.
absolutely. And this is
And
like how investment works.
this is how investment works for sure. All right. And that has been our educational class for the day. These are the four companies that we're looking at. And the portfolio is a little bit larger, but these ones are the ones that we are paying attention to at this moment. That's everything I have for today.
Subscribe, like, comment, ask questions, and we will be happy to answer. And
All
see
right.
you till the next episode.
See you on the next episode and have a great rest of your week.